Hello, everyone. So, today we are going to learn something which is fixed income. So, what is fixed income? Any security which gives us fixed income? What are the securities? So, when we go out and put our money for investments, we have different options available for investment. It may be equity shares, it may be preference shares. So, and you also may have debt. In debt, you have different options. It may be bonds, it may be debentures. Again, in bonds, it may be corporate bonds or it may be government bonds, GSEC, anything it can be, right? So, when you go for shares of the company, you are kind of taking the ownership of the company. And when you are taking ownership of the company, obviously you have to take some amount of risk. So there is some risk involved here which you have to bear. But when we talk about government securities, people generally call it as risk free security. 10-year government of India bond is called as risk free. But generally, if you see, there is nothing risk free in the world. So a small statistics, if I show you, you can see about country risk premium. So every country, even if you invest in US, even if you invest in UK, anywhere, so when we come to India, so you can see 2.18%. So even if you invest in government of India bond, which gives you maybe 10% return, 10 is too high, so 8% return, so still 2.18% is going to be what? It is going to be the country risk. So there is nothing risk free as such, but generally we consider it as much risk free because the return here is very low. So obviously you may get 5 to 6% return here, but when you go to equities you may get 12 to 14%, 20% and whatnot. So it completely depends. So in equity shares, if you have bought a equity share of rupees 100, it may go to 60 next year, it may go to 150, 180, 200 also. But if you have bought bond, then you are sure that if you have bought it for 100, it will not go to 96, 95, it will definitely go to 108, 110, whatever is the maturity value of the bond. So how's that works? That basically works as lower the risk, lower the return. This is for bonds, and for equities it will be reversed, which is higher the risk, higher the return. Yes. So obviously with risk the return obviously comes. Return ज़्यादा होगा तो risk भी ज़्यादा होगा. Return come, then risk is also less. Apart from this country risk, yeah. So coming to the point of risk again, when we call it when we call about risk, how you would say, how what's the risk? So suppose the company has earned 100 crores of profit this year. So the company will distribute the profit. Company has to give to debt first. So company might give to debt, let's say they have the interest 20 crores. Whatever is remaining belongs to equity. Everything remaining belongs to equity. Okay, but is it that the situation is going to be rosy always? No, that's not the case. Sometimes it is possible that so let's say this net profit comes to 30 crores or 20 crores only. Okay, or let's take the worst case, 10 crores. So company has to pay to debt 20 to 20 crores anyhow. Company will be in minus 10 net profit. So company will not be having anything to give to equity holders, because equity holders, being the owners of the company, they have taken that risk that it's okay if you don't earn anything, we don't want anything. Oh, even in the case of liquidation, so let's say there is liquidation happening and company is having 500 crores debt, 500 crores equity. to repay. But will the company be able to repay this? So let's say if this company is having the assets minus liabilities as 700 crores. Now, whom the 700 crores will go? It will first, debt will be fully repaid, and whatever is remaining, 200 crores will go to equity. So, equity people have to take a cut here. Why? Because if the profits are high, they will enjoy higher profits also, and if the profits are low, then they have to bear that risk also. So or if I take the case that the company has only 200 crores, so these 200 crores will all go to debt and nothing will go to equity will not get anything. So that's how the risk plays an important role when we go to debt, compare debt and equity, and then we say that when you go for debt, you get a fixed income. So that's why it is called as all the securities which give you fixed income, that is your principal remains safe. You are you can call them as fixed income securities. Now when I come to a bond is very different, quite a different product than FD or something. So let's understand bond. Now, when you generally take FD in the bank, how does that work? You give to bank 100, right? 100 rupees, $100, whatever, and bank. So let's say you gave $100 to bank and 4% return is the annual return, and after a span of 1 year bank will return you $104, right? So that happens in the case of FD. But in the case of bond, this will not happen. In the case of bond, let's say you expect 4% or something around 4%. Let's not take the exact for now. So for bond, it will give to bank $96. Okay, bank or the bondholder, whatever it is, and then he will get in return $100. So 100 is what? 100 is face value. So whatever is the face value of the bond, what you get in return, what the customer gets in return, he gets in return, bondholder gets in return the face value, which is constant. So he will get face value of the bond in return, right? And how does that work? So when suppose we will say the price of the bond. Price of the bond is the value at which you invest in the bond, and face value is something which you get at the maturity of the bond, and that maturity may be 1 year, 2 year, 3 year, 4 year, or any period of time. It's not it depends, obviously it is fixed, but it depends what the maturity is. So face value, you can say this is the promised principal repayment to you, which is fixed, right? So when we see, this is the person A who is the bond holder, and this is the person B. So this person might have invested $98 with the maybe the bank, and this bond holder, what will he get after a span of 1 year? After a span of 1 year, he will get $100 from that particular corporate bond, right? And at the time of maturity, what you're getting is you're getting $98, your principal back, plus $2, which is interest. And what is this interest called? Interest is called as coupon. Okay, so in the language of bond, this is something which is called as coupon. So the price, if you say, no, I don't want to work for 2% coupon, I want 3% coupon. So how will that work? you will get in return the face value which is fixed. So face value is not going to change. This is not going to change. So what will change? Your price of the bond, that is the value at which you have invested your money, that is going to change, right? So if you say that that price of the bond would be what, obviously that price of the bond would be anything less than 100. if 100 अगर फेस वैल्यू है, अगर ये आपको मेच्योरिटी पे मिलेगा, तो प्राइस कितना होगा? एनीथिंग लेस देन 100, right? And what price it will be, that would depend on many factors. That depends on risk. So because there is a risk now, even if you have bought the bond, what if the company is not able to return you the money? So there is some default risk, there is some country risk, obviously. So if you want higher return, if you're expecting, as a bondholder, if you're expecting a higher return, then your cost at which you are buying this particular bond has to be low. So it depends. If the company suffers the loss, then at that time the company might occur default, and for that risk we are getting this money. So let's consider that our return requirement is 3%. I'm saying my return requirement is not 2%, it is 3%. And face value of the bond, that is what money I will get back, is $100, what we have decided earlier. So as per you, what will be price of the bond? What will be price of the bond? So the price of the bond is something which you pay at day 0, and this face value of the bond, this price of the bond is something which you pay at day 0, and this face value is something which you will get it in the future, right? So basically this is my present value and this is my future value, and this is something, the money which I am getting for the wait, which you can call it as time value of money. So basically here I don't know my present value, I know my future value as 100, and return I know is 3%. So if I am saying that this is a 1-year bond, then how would I calculate? If in the earlier case, when you said that you were getting 2 rupees and you were investing 98, and at that time you was getting in return 100, at that time it was a very simple calculation. You will say I am getting 2 rupees, right? That is my interest or coupon, and this is my investment value. Then how much I am getting in return? So you can say 2.041%. So that was very, very simple. But if the question goes reverse and it asks you that how much you have to invest, if your required rate of return is 3%, then how much you have to invest? So if you remember, we had learned this in school. This is future value is equals to present value 1 plus I raised to n. Future value you know is 100. Obviously, you don't know present value, and 1 plus I, so 1 plus 3% raised. So even when you check in Excel that this value plus this value ka 3%, then you will get the same value as 100. That is, you will get 100 at the end of the year. Let's go on to the next thing, which is types of bonds. So there are different types of bonds, but mainly let's consider coupon bonds, zero coupon bonds, one, and second we can focus on is coupon bearing bonds, and the third one may be perpetuity bonds. So what are these type of bonds? When I talk about zero coupon bonds, is the same bonds which we spoke about now, that you invest 97, $98 whatever and get in return $100. So that is the simplest thing. When you so there is no coupon. Basically you are buying at a discounted price, and what you are getting at the end is the face value. Well, the next one, which is coupon bearing bonds. So how does these coupon bearing bonds work? These bonds basically give you coupon. How do they give you coupon? So suppose if you have invested, let's say $95 at the end, at the start of year one. So at the basically you have invested at day zero, at year zero. So how will that work? If you have to invest, if you have to invest in, if you have to invest, yeah, in this bond, if you're investing, let's say $95. So you have put in your $95 in year zero. Let's say this is a maybe 7% coupon bond, and rupees 100 is the face value. So you will get whether we can take it dollar or 100. So let's take it dollar. So $7 you will get at the end of year one. Year two again you will get $7. Year three again you will get $7. So whatever is the period of the bond, let's take the period of the bond as 4 years bonds. So if I take it 4 years, so in the year 4 you have invested 95. So 95 is the basically negative cash flow. This is the positive cash flow which you are getting, right, as a coupon. In the 4th year you will get your coupon plus the face value of the bond back. So this is how these coupons work. However, if it would have been the case of FD, it would have been very, very different, because you would have invested $100 in the year one, and whatever interest you might have got. So let's say 7,777, and in the last year you will get the same 100 back. Right? So the only difference is the price of the bond. The price here, the price in FD, the price and the principal value remains same, but in case of bond, the price and the principal maturity value which you get at the end is different. Correct? Yeah. So and when we see these bonds, when we see the cash flow of these bonds, these cash flows can be different as well if the bond is semi-annually. So let's take the, if the bond is semi-annually, so this 7 interest would be 3.5. So this will be year 1, you will get 3.5. So this is first 6 months, this is next 6 months. Again in year 2, 3.5, first 6 months, next 6 months. Again year 3, same thing, and year 4 it will be 3.5, and in the year 4 it will be 3.5 plus 100, whereas you have put in $95 at the start. So semi-annually works like that. So basically in semi-annually versus annually, if annually bond is of $100, you will be getting, so let's say if this is for 10 years, so you will get how many coupons? You will get 10 coupons, because you are about to get annually. But when I say about semi-annually, then if the bond is for the duration period of 10 years, you will get 20 coupons. And let's say if the bond is quarterly, then in 10 years bond, how many you will get coupons? You will get 40 coupons in that period, right? So yeah, it works differently for different bonds. And let's see the one which is perpetuity bond. So what is perpetuity bond? Perpetuity bond is basically when you receive the coupons at the end. So you don't receive the coupon again and again. Obviously you receive the coupon. So here you receive the coupon every time, maybe annually, maybe semi-annually, you will receive the coupon as like the general bond. But the main difference is you will not receive the principal. You will receive the not receive the principal till infinity. So maybe it may be a 100-year bond or something. Perpetuity bonds are not redeemable. So the principal goes on, the bond goes on till the company goes on, and you will be getting only coupons and coupons at the regular interval period, whatever is the interval period selected by you. Let's understand yield. So what is yield? When we talk about yield to maturity, what is the yield of the bond? So when we speak about yield, this is basically the rate of return you have earned on the bond. So it completely depends what rate of return you have on the bond. When I say this is a 100 face value bond and this is a 7% coupon bond, it does not mean that your yield is 7%, your rate of return is 7%. No, this means that you will be getting coupon 7% of 100. So you will be getting coupon of 7. But does that mean that you will earn the same? No, that completely depends on the price of the bond. So suppose your price of the bond was rupees, let's say you have bought the bond for rupees 95. So I will say that you have earned 7 on 95. So whatever percentages it is, whatever percentage it is, so you can say 7 divided by 95. So how much percentage it is? It is 7.37%. So you have earned 7.37% and not 7%. So that's the difference we have to understand between yield and coupon. Yield and coupon are two different things. So whenever price of the bond, you can see if this increases from 95 to 96, so the bond becomes costlier, your rate of return will reduce, right? So the more and more the price of the bond increases, your yield is going to decrease. And if you want more yield, if you say no, I want more yield, I want this much yield, then what you have to do is you have to make sure that whatever bonds you are buying, the price of the bond should be less. You have to make sure on that. When we calculate present value to future value, so when you go from present value to future value, it is you have to work on compounding, right? But when you go from future value to present value, you have to do discounting. Here basically you have to multiply, here you have to divide. So I will check how much price of the bond I want by the principles of discounting. I have to use the principles of discounting in order to get how much should be the price of the bond. So any example we can take it as, if you say that I want 10% yield. Okay, so suppose you want 10% yield and you and the face value of the bond is 100. So how much you will get in return? Obviously you will get in return at the maturity pay you will get 100. But what should be the price of the bond? So price of the bond is what? Is my present value, and this face value is what? Is my future value. Right? So how will we get? Present value is equals to future value 1 plus I raised to n. Therefore, I will say that my face value is 100 and 1 plus I is 10% and raised to I will keep it as 1. So when I say 100 divided by 1.1, therefore 100 divided by 1.1, this is something 90.90. And you can check that as well. So you check that as in how much it is. So I will say how much it will be. it will be present value rate. What is the rate? So rate is minus 10%. 10% rate, comma, n per is 1 year, comma, BMT is 0, and this value is 100. And yeah, so when I check in Excel, I'll get the same value, which is 90.91. So this is if it is for a span of 1 year. It might be for a span of 2 years, 3 years, 4 years. If it is for a span of 2 years, for a span of 2 years, you can change this value. So it becomes 82.64. So this value, obviously, if I say, if I make it raised to 2, then this value comes to 82.64. And thus this value, if let's say if you want it for a 5-year period, so it will get how much money? How much? 10% for one period of time. PMT is 0. Face value here, it would be same 100. Okay, and yeah, I'll consider it at the end of the period. The price is 90.91, 90.90 to be rounded off. Right. So now we can see that present value you can change, right? Future value remains constant because आपको future value 100 rupees का bond है, so it will remain 100. If it is a 1,000 rupees bond, 10,000 rupees bond, whatever bond can be any of any face value, but that remains constant. That doesn't changes, right? And when we come to time period, it also keeps on changing. You can buy 2-year bond, 4-year bond, 7-year bond. It changes. And obviously your yield. So the yield you will get on it, that also changes. So when I say let's get the value of the bond, value of the 5-year bond. Okay. So in that case, what will happen? N will become 5. Right, n will become 5. So my same formula, which is present value is equals to future value upon 1 plus I raised to n. So I will say 100 upon 1 plus 10%, which was 1.01, that will become raised to 5. So this is 100 upon 1.1 raised to 5, and then we have to solve it. So yeah, this value would be around 62.09. You can check it in Excel. It becomes very easy in Excel. So the same one, only the n per, the period will become 5 year, and the answer is 62.09. And then you can calculate also, that this 62.09. So in the first year, you have spent 62.09. In the second year, third year, every year you will get 10, 10, 10, 10, 10. And in the last year, you will get 100 also. And you can check what is the value of the bond. So 62.09 into 1.1. In the second year, it will be 62.09 into 1.1 raised to 2, and like that. And if you go further, obviously you will end up getting 100. Yes, so if in the market interest rate, but this is the situation when the interest rate remains constant, which is 10%. There is a possibility that the interest rate would change. Interest rate